Welcome to TheoTrade. This is Don Kaufman. It's October 30th, 2019, and you are watching the TheoTrade evening video. 4 minutes left inside of the cash trading session with the S&Ps up about 850 in the aftermath of the FOMC announcement. What did they do? Well, precisely what we've kind of dictated over the last couple of trading sessions. There was no real surprises today in what the Fed said. What did they do? They lowered rates. What did they also do? They called their version of quantitative easing not quantitative easing. They're just easing up on the balance sheet. For the most part, they are out there buying assets, but they are not calling it quantitative easing. Again, I could have probably written some of the Jerome Powell speech of what I call not quantitative easing. But more pressing and more important, right here, right now, listen, these sectors leave the markets highly vulnerable right now to a sell-off. Now listen, I am absolutely unequivocally carrying some bearish positions. Whether you have bullish or bearish positions, pay very careful attention to what I'm about to describe to you. Now, after today's close, which is only a few moments away, there's going to be some big earnings, right? The likes of Apple. Now, Apple does not come out immediately after the close. They wait, they pause. There's going to be Apple. There's going to be Starbucks. There's going to be Facebook. You've got Altria Group in the morning. Obviously, that's not going to be a market-setting event. But Apple absolutely could be, along with Facebook. Okay, aside of the tech-heavy discussion in earnings, let me show you some of the vulnerabilities to this marketplace. One of the first things that I would be remiss not to point out, okay, is that the S&Ps, they didn't really react per se to Jerome Powell. In fact, when you start looking at the S&Ps, if you didn't know there was a Fed announcement, this might look like any other trading session. Right here was the actual announcement. We rallied. We sold off a little bit on some of the speech. We rallied back up. Now, where do I see vulnerabilities? Obviously, you can see right here that the Russell happens to be down, but that's not what's causing some of the vulnerabilities. Some of the vulnerabilities are being caused, okay, right there inside of the bond market. So the bond market rallied. Now, to detail this a bit more, and I do want to go into greater detail. I want to show you in the S&Ps. The S&Ps are doing just about 1 million contracts, which once again, this doesn't feel like a big blistering rally. We've got what I would term, okay, positive drift to the marketplace. Look, okay, you can't tell there was an FOMC announcement today, and I'm telling you, there's much more to come here. What you can see, though, is the movement inside of the bond product. The bonds, yeah, they're rocking. And you better pay attention to this because the bonds, they haven't necessarily broken out on volume, but there's definitely, we're in the big leagues in terms of volume on the bonds. Because the bonds have rallied, that impacts, okay, the interest rate. Now I'm going to pull up TNX. TNX, see the interest rates are headed back down. The moment the interest rates are headed back down, you start to leave the financials, again, vulnerable. Now, you might not see a pickup in volume yet inside of these financials, but the vulnerability happens to be if those financials, if they eke out, okay, anything today, it would be amazing given the fact that the bonds are up. Again, this is a 0.7 ticks. This is big movement. The financials aren't just vulnerable in terms of their price declining here in the coming days. Again, if the bonds continue to the upside, it will crack the financials. If you crack the financials, you're actually going to take down the S&Ps. In fact, you got the S&Ps rallying here, but you wouldn't know it looking at the advanced decline line. The advanced decline line in the S&Ps is an utter slop fest. Okay, slop fest denotes about a 50-50 advanced decline line. Why do I call it a slop fest? Because the S&Ps, it's filled. The S&P 100 is filled, okay, with different financial products. Now, what I would also concern myself with here inside of the financials is the implied volatility. Now, let me kind of zoom into the implied volatility for just 1 second. I'm actually going to go ahead and freeze the screen. There's the closing bell. The implied vol of these financials, just for the remaining, well, you have what, Thursday and Friday, you're still sitting at about 17%. 17% implied vol. How does that compare, for example, to the next, couple of sessions inside something like the SPX? Well, the SPX happens to have a Thursday expiration and a Friday expiration because they have end of month expiration and a Friday, just to compare and contrast. Okay. For Friday, the S&Ps have under 11%. Okay. Again, compare and contrast the financials almost sitting at double that. In fact, the financials earlier today did have over a 22% implied volatility. Some of that came out. So get ready for movement inside of the financials. Now, that's not the only sector worth discussing. And as I just pointed out a moment ago, it's a vulnerability. Again, the bonds, these things look like they are, in fact, going to take off to the upside, in which case you can assume that the financials are going to get pressure. But the other issue stems from what's going on right here. Now, here happens to be the energy sector. Okay, this is where earnings are absolutely going to come into play. You've got ConocoPhillips, you've got Chevron, you've got ExxonMobil. I mean, they're all coming out, okay, throughout the course of this week. Nevertheless, right now you have the energy sector, okay? The energy sector is down. So you've already kicked out kind of a leg underneath the S&Ps. On top of it, you have the financials vulnerable. They're not down yet, but they're vulnerable. You kick the financials along with energy, you got yourself some sell side activity to the broader S&P 500, and that is what's important. The other aspect that begs to be discussed, okay, is you can see the XLU, which is none other than, it's not the most exciting thing, it's utilities. A big bid under utilities. Almost a 1% move under utilities today. That can be more than construed as defensive to the marketplace. Again, a moment ago, we're looking at the advanced decline line, but I think it's also worth taking a look at some of the sectors themselves. You can see energy down in a big way. The financials are massively unchanged in the trading day. Look down the list of usual suspects, though, and you see utilities. That's the number one performing sector of today's trading session. That, per se, is not a good thing. Again, is not a good thing. The final aspect that I want to kind of leave you with in tonight's video is that, so the Fed came out. Listen, it wasn't necessarily the Fed that was supposed to spark the volatility. There's a lot more going on. Okay, today, tomorrow, again, we've got economic reports dropping like news bombs out there. If there's going to be a short-term top to this marketplace, I want you to mark this in your head, on your screen, wherever you need to. 30.55, which is the upper edge, again, the upper edge of the expected move inside of the SPX. Could be likely, even plausible that we hit that in the overnight trading session. Nevertheless, you have a marketplace that is absolutely vulnerable right now. Those sectors I pointed out, including the financials, the energy sector, and specifically the utilities, leave this marketplace highly vulnerable to sell-side activity. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.